Picture this. Every month, money hits your account without you lifting a finger, cash from companies rewarding you for owning their stock. That's the power of dividend investing. Want to build a stream of passive income that grows over time? Let's dive in. What is dividend investing? Dividend investing is like planting a tree that drops cash instead of fruit. You buy stocks in companies that pay regular dividends, portions of their profits distributed to shareholders, typically quarterly. These payments become a steady income stream, perfect for anyone craving financial freedom without selling asset. Take Maria, a 35-year-old accountant with $5,000 to invest. She's drawn to dividend stocks because they offer income now and growth later. Companies like Procter & Gamble or Coca-Cola, with decades of consistent payouts, are her go-to. Historically, dividend-paying stocks in the S&P 500 have delivered 9.2% annual returns from 1973 to 2023 per S&P Global, blending income and appreciation. Dividends signal strength. Companies paying them are often stable, with reliable cash flows. But it's not just about the cash. Reinvesting dividends supercharges growth through compounding. Maria uses a dividend calculator online and sees that $200 monthly into a 3% yield stock could grow to $150,000 in 20 years, assuming 7% total returns. Practically, Maria opens a brokerage account with Schwab, screening for stocks with yields above 2% and a history of raising dividends. It's not get rich quick. It's about building a reliable income machine. Emotionally, it's empowering, knowing your money works for you, not the other way around. Identifying strong dividend stocks. Finding the right dividend stocks is like picking tenants for a rental property. You want reliability and growth. Look for companies with a dividend yield, annual dividend divided by stock price, between 2-5%. Too high can signal risk. Check payout ratio. Under 60% means the company can sustain payments without straining profit. For example, David, a 42-year-old teacher, uses Finviz to filter stocks with 10-plus years of dividend increases, known as dividend aristocrats. He finds a utility company yielding 3.5% with a 50% payout ratio. Digging into its 10K report, he sees steady revenue from a loyal customer base, a sign of durability. Qualitative factors matter too. Does the company have a moat, like Johnson & Johnson's brand dominance in healthcare? David checks X posts for sentiment, noting investor confidence in its stability. A 2022 Morningstar study showed aristocrats outperformed non-dividend stocks by 2% annually over 20 years. Avoid traps. High yields like 10% often mean trouble, like a struggling retailer slashing dividend. David cross-checks with Seeking Alpha for analyst takes, ensuring his picks are solid bets for long-term income. Understanding dividend yield and growth. Dividend yield is your income engine, but growth in payouts is the turbocharger. Yield tells you immediate return. Like a 3% yield on a $100 stock pays $3 yearly. But companies raising dividends annually, like PepsiCo's 50-year streak, boost your income over time. Consider Aisha, a 29-year-old nurse investing $2,000. She picks a stock with a 2.8% yield and 7% annual dividend growth. Using a compound interest calculator, she projects her $56 yearly dividend growing to $150 in 15 years, assuming reinvestment. Historical data from S&P Dow Jones Indices shows dividend growers averaged 10.2% returns from 2000 to 2020, beating static payers. Growth signals confidence. Companies like Microsoft raise dividends as earnings climb. Aisha checks financials. Low debt to equity, under 1, and consistent earnings growth confirm sustainability. She avoids firms with erratic payouts, like some energy stocks in 2020's oil crash. Practically, Aisha uses dividend history trackers on Dividend.com to spot consistent growers. This focus on rising payouts feels like building a snowball, small now, massive later. Building a dividend portfolio. A dividend portfolio is your personal ATM, but it needs balance to hum. Aim for 10 to 20 stocks across sectors like consumer staples, utilities, and healthcare to spread risk. ETFs like SCHD, Schwab US Dividend Equity, offer instant diversification with 3% plus yield. For instance, Liam, a 31-year-old freelancer, splits $3,000 between 5 stocks, 2 in healthcare, 2 in consumer goods, 1 in telecom, and 20% in an ETF. When healthcare dips, his telecom stock's steady 4% yield cushions the blow. Morningstar data shows diversified dividend portfolios cut volatility by 15% versus single-sector bets from 2010 to 2020. Rebalance annually. Sell if a stock's yield drops due to price spikes or dividend cut. Liam uses personal capital to track income and growth, aiming for 3 to 4% average yield. This setup feels secure, like a safety net generating cash flow. Allocate based on goals. More stocks for growth, more ETFs for stability. Liam automates reinvestment via his brokerage's DRIP, Dividend Reinvestment Plan, compounding his returns. It's a system that works while he sleeps. Reinvesting dividends for compounding. Compounding is the secret sauce of dividend investing. Reinvested dividends buy more shares, which pay more dividends, creating a wealth spiral. A 2023 Vanguard study showed reinvesting dividends boosted returns by 2 to 3% annually over 30 years versus taking cash. Take Sophia, a 38-year-old small business owner. She invests $4,000 in a stock yielding 3%. Reinvesting dividends, her 100 shares grow to 150 in 10 years, assuming 6% stock growth and steady dividends. Without reinvestment, she'd miss 30% of potential gains. Practically, Sophia enables DRIP on her brokerage, automatically buying fractional shares with dividend. She tracks via apps like Yahoo Finance, watching her share count climb. During 2020's market dip, reinvesting scooped cheaper shares, amplifying her recovery. Emotionally, it's satisfying. Each reinvested dividend feels like planting a seed for future wealth. Sophia balances reinvesting with taking some cash for expenses, tailoring her strategy to life's need. Managing risks in dividend investing. Dividend stocks aren't risk-free. Cuts or market drops can hurt. Mitigate by focusing on quality. Companies with strong balance sheets and low payout ratios. A 2021 S&P report noted dividend aristocrats had 50% lower volatility than the broader market. For example, Noah, a 26-year-old barista, picks stocks with debt-to-equity under 0.8. When one stock's payout ratio spikes to 90%, he sells, avoiding a 2022 cut that tanked its price. He diversifies across 12 stocks, limiting any single hit to 10% of his portfolio. Market downturns test patience. Dividend stocks fell 20% in 2008 but recovered by 2010. Noah uses stop-loss orders at 15% below purchase to protect capital, balancing risk with income goals. Monitor news via X for red flags like lawsuits or sector slump. Noah's proactive approach, checking quarterly reports, keeps his income stream steady and stress low. When to buy and sell dividend stock. Buy when fundamentals align. Stable earnings, reasonable yield, and growth potential. Avoid chasing high yields. 8% plus often signals distress. Sell if dividends are cut, fundamentals weaken, or the stock's price outpaces its value, lowering yield. Mia, a 33-year-old consultant, buys a 3.2% yield stock at $50, expecting 5% dividend growth. 2 years later, at $80, the yield drops to 2%, and she sells, locking in gains. A 2020 Fidelity study showed disciplined selling boosted dividend portfolio returns by 1.5% annually. Set alerts for earnings or dividend announcements via TradingView. Mia exits a stock when its payout ratio hits 80%, signaling risk. She waits for dips to buy, like 2022's market pullback, grabbing quality stocks at discounts. Avoid emotional holds. If a company's story sours, like retail during e-commerce shifts, cut losses. Mia's rules-based approach keeps her portfolio income-focused and resilient. Monitoring and adjusting your dividend strategy. Treat your portfolio like a garden. Check regularly, prune when needed. Review quarterly. Are dividends growing? Are payout ratios sustainable? Use tools like Dividend.com for updates. For example, Elena, a 40-year-old nurse, tracks her 10-stock portfolio with Morningstar. When one stock's yield drops due to a price surge, she rebalances, buying a higher-yield peer. A 2022 J.P. Morgan study showed rebalanced dividend portfolios outperformed static ones by 2%. Adjust for life changes. Elena takes dividends as cash when saving for a house, then reinvests later. Monitor macro trends via X. Rising rates can pressure dividend stocks, so shift to defensive sectors like utilities. Elena's discipline, checking metrics, not reacting to noise, ensures her income grows steadily, building confidence and cash flow. Dividend investing is your path to passive income, steady cash from stocks that reward you for holding. We've covered picking strong dividend stocks, leveraging compounding, managing risks, and building a portfolio that pays you to live. Start today. Research one stock, open an account, and plant the seeds for financial freedom. Your future self will thank you. Check the description or pinned comment for free tools and exclusive dividend stock picks to get you started. Since you're still here, YouTube's got the perfect next video for you. It's on screen now, so keep building that income stream.